Welcome back to everyone again. This is Scott McLennan from the Charter Hall Direct team. Well, when we look back on this year, it really has been a story about continued inflation and interest rate rises around the globe as central banks continue to struggle with keeping inflation under control. The war in Europe continues to be disruptive in the supply chain of certain essential commodities, including grain, gas and fuel, contributing to these pressures on prices. As for Australia, it's seen a year of extraordinary natural disasters. We've witnessed record rainfall and flooding in certain locations, with some areas being evacuated for a third time. Thank you for those who have generously assisted in the relief efforts and contributed to the re-establishment of those communities who have been severely impacted. All round, it's been a tough year for investors, seeking a continued flight to quality and safe havens. As equity markets remain volatile, we've seen investors favour US dollar assets, which has resulted in a fall of our local currency from US 70 cents to its current trading levels around 63 US cents. In highlights across our direct business, our popular PFA fund, a predominantly government tenanted office fund, had its major liquidity event in October, which recently closed, with investors demonstrating continued strong support for the fund. Across the suite, we also saw good support in our industrial and office sectors, with confidence returning to the office market as the impacts of COVID and a steady support for a return to CBD for office workers continues. Pleasing also to see increased activity in our listed maximum property securities fund as investors look to see value in the public markets. Well, thank you to all our advisors who continue to support our business. We want to take this opportunity to wish you all a safe and happy Christmas and look forward to speaking with you again in the new year. Enjoy Stephen's update and see you again soon.
Thank you for joining us for an update on the Charter Hall Direct suite of funds performance at the end of the September 2022 quarter. I'm Stephen Bennett and I'm the CEO of the Direct business here at Charter Hall. The Direct business is part of the wider Charter Hall Group, which has grown to become one of Australia's leading fully integrated property investment and funds management businesses. We have over 1,500 assets and over $80 billion in funds under management. Now, let's jump into today's presentation. I'd like to begin today by acknowledging the traditional custodians of the land on which we gather today and pay my respects to their elders past, present and emerging. I'd also like to thank you for joining me for this update on both Charter Hall and our suite of direct funds for the September 2022 quarter. I'd also like to remind you that we are not able to provide financial advice. Today's information is an update on our funds, and the market and the economy more generally. If you have queries that relate to your own personal investment situation, we always encourage you to consult your financial advisor, to read the product disclosure statement or the information memorandum in full and focus on the risk sections. Today's agenda will follow a similar pattern to previous quarterly updates, being a short overview on the Charter Hall Group. I'll run through how the funds are performing, then I'll provide an overview of the key sectors of office and industrial today, and then you'll hear from our guest speakers, Andrew Cole and Sarah Blankfield, on the ESG side of things, and I'll finish with a direct fund update. As at 30 September, Charter Hall now manage $83.4 billion of funds under management. In fact, we're the largest owner of real estate in the country, and we cover all the core sectors of office, industrial and logistics, convenience retail and social infrastructure. As you can see, the pie chart on the right shows the different allocations comprising that $83.4 billion. And as always, at Charter Hall we focus on strong tenant covenants, long-term leases, and I'll show a slide later today on the high occupancy levels we've maintained over very long periods of time for our two office funds, the Direct Office Fund and PFA. So this slide that's popped up on the screen shows the performance of the open funds in the 12 months to 30 September 2022. I purposely won't focus too much on this because, as I said many times before, unlisted real estate should be a medium to long-term investment. But what you can see from these charts is the blue bars, the highest performing fund in the 12-month period was DIF 4, not surprising, it's in industrial and logistics, and the lowest was DOF at 11.9%. However, all funds outperformed the benchmark index, which is the grey bar on the right. And at double-digit returns, this is a fantastic result for all of the open funds. Now this chart I think is more important than the previous one, and it's because the performance is since inception, i.e. when the fund was first launched. Similar colour coding, the blue bars represents the fund performance, and this is returns per annum comprised of distributions and movements in the value of the unit price, and the grey bar represents the benchmark. But as you can see, every single one of these funds has materially outperformed the benchmark since it was first launched. This is a great result and something the team are very proud of at Charter Hall, being able to deliver such long-term returns for our investors over such a vast array of products. So this slide now up on the screen shows the return of our funds which are closed for investment, i.e. investors cannot access them any longer. But what you will see is the blue bars materially outperformed the benchmark returns highlighted in grey. And you may notice that these returns are slightly higher than some of the funds on the previous slide. That's largely because these funds have slightly higher gearing levels. Moving now through to what it means for each of the underlying funds. I won't read them out, but you can see them up on the screen, the fund's unit prices as at 30 September. You will note some small decreases during the quarter, and that's because the way costs are amortised, so the biggest costs are stamp duty and due diligence and legal costs, we accrue them into the unit price and we amortise them over 5 years. So the way we manage our funds at Charter Hall, each portfolio is independently valued at 30 June and 31 December. And traditionally what you do see during that 6-month period is the unit price to come off slightly as these costs are amortised. What we've also done is we've highlighted on the column on the right the type of investment, noting that they are all illiquid investments except for the bottom one, the Maxim Property Securities Fund. Because it invests into stocks traded on the ASX, you can get your money back within 3 days. However, we always tell people that property is a medium to long-term investment, so regardless of whether it's liquid or illiquid, we do encourage you to keep those time horizons. The major valuation movements for our funds occur at those independent valuation dates of 30 June and 31 December. And we're in the September quarter now. So I'll spend less time on the individual funds, but I will take that extra time to give you a bit more of an overview of what's happening in the economy, both in Australia and a global context. The chart there on the left shows what's happening around global inflation. It's a little bit hard to see, but Australia is represented by the red line. Probably what's most important to take from that chart is all the countries are on a similar trajectory. Then on the right side, you can see Australian headline CPI. You will see a question mark on the right, and I've purposely done that because not only have all the central banks and governments around the world got it consistently wrong for the last almost 12 months, I don't pretend to stand up here and tell you what inflation will do. What I can tell you is that the central banks throughout the world are adamant that they're looking to get inflation under control, and that's why you've seen interest rates move so highly. But depending on which economist or market expert you listen to, the expectations, and we've already seen this with the RBA here in Australia, is that those interest rate increases will slow, and then sometime next year they're likely to pause, and then in the medium term the expectation is that as inflation comes back down, so too will those interest rate levels. I also thought it'd be helpful to put Australia in a global context. I'm sure we've all heard about the deficit. The Labor federal government's just had its first budget. What this chart shows is the percentage debt to GDP of all the major countries in the world. You can see here Australia at 57% is one of the lowest. And in fact, even on the forward-looking period, the expectation is that that deficit won't grow in a material way. The reason why I put in this slide up there is it does show you that the Australian economy from a debt perspective is more likely to be resilient, and the government has more levers to pull if it does want to increase the spending. Over on the right side, you can see Japan at 264% is leading the way, and this isn't a race that you want to win, but the key takeaways are that smaller economies like Australia having a low debt ratio is a good thing over the long term. So continuing to look at Australia in a global context, and one of the benefits of Charter Hall is we do speak to some of the largest global investors in the world. We hear what they're thinking and we hear why they do like Australia as an investment destination. What you can see on a risk indicator, Australia is second lowest, only behind Switzerland, out of 164 countries on this economical risk profile. In fact, Australia is below the Asia Pacific average for all assessed risk metrics, and this highlights our ability to withstand volatility and any potential looming risks that the global economy may face. This next chart highlights Australia's superannuation industry, or the pension market as most of the world calls it, and how the size of our super funds compares to other major countries. In fact, Australia has the 5th largest pension fund market, despite only having the 56th largest population. Australia had the highest growth rate in our super and pension accounts at 11.6%. What this means is Australia has a growing and deep investment pool, and we are no longer so dependent on the outside world to import capital. In fact, many Australian super funds are increasingly looking on a global context to make sure that they have assets that will deliver for their investors. So I've now framed Australia in a global context, highlighting that we have a low debt to GDP ratio compared to other major economies throughout the world. On an economic risk measure, we rank second, only behind Switzerland, and we are lower risk than all other Asia Pacific metrics per this survey. And we have the 5th largest superannuation and pension fund sector in the world. What I'll now do is I'll bring it through to what we're seeing in some of the specific property sectors that Charter Hall are focused on. This slide up there on the screen shows the industrial and logistics rental growth rates all the way back to 2002. And what you can see on that far right-hand side, in the 12 months to 30 September, the industrial and logistics market in this country has generated 22% rental growth. It's done that because most of the major markets have little to no vacancy. There's a shortage of zoned land, and we're also seeing increased tenant demand through trends which I've already spoke about in many quarterly reports previously around e-commerce, onshoring, and making sure that the retailers have the footprint to expand. This rental growth has been underpinning some of the significant capital appreciation which we've witnessed in the Australian industrial and logistics market. That last slide I showed was the national average. This slide up here on the screen shows each of the major industrial and logistics markets within Australia. The blue bars show the rental growth in that market, and the grey bars show the 10-year compound average growth rate, or CAGR. I won't draw out specific markets, but what you can see is that the rental growth is significantly exceeding those long-term averages. And whilst we aren't expecting the rental growth rate to continue at such a brisk pace, the structural tailwinds for tenant demand, some of the challenges around securing those sites, the increase in the building costs are expected to mean that over the medium to long term, Australian industrial and logistics property will continue to have outsized rental growth expectations. This next slide shows the full-time employment and part-time employment growth, the full-time being those light blue bars up there on the screen, and the grey bars representing part-time employment. Overlaid across that is the dotted blue line showing the unemployment rate. What you can see there is that we had a loss of employment opportunities, not surprising, and was very well known throughout COVID, but the market has roared back. In fact, unemployment is now at its lowest level in 50 years. The reason why I'm highlighting this is that white-collar employment, whether it's full-time or part-time, is a significant driver for office tenant demand. So this level of unemployment is unlikely to be sustained, and what we're expecting is that as net immigration ramps up, the total volume of employed workers will increase, even if that unemployment rate begins to tick up slightly from its record low rates we see today. This next slide is one of my favourites. It shows the return profile per annum, so distributions and movements in capital value on the vertical axis, and on the horizontal axis, it shows volatility. Volatility is a measure of risk. So what in an ideal circumstance you have here is higher returns with lower levels of volatility. We've then charted a lot of the major commercial property markets in the world. And what you can see here across 3 different time periods, 10, 15 and 20 years, Australia not only has higher average rental returns than most other markets, but it's achieved it with lower levels of volatility. So the ideal place to be in this graph is the top left, meaning higher returns, less volatility, and the bottom right is where you don't want to be. But as you can see, against France, Canada, Netherlands, Hong Kong, the US, Australia compares extremely favourably. So I've painted the overall picture around the office market. The total volume of workers is expected to increase. I've talked about on a risk-adjusted basis how Australia office markets compare favourably to other major office markets in the world. But all office assets are not created equally. The chart here you can see up there on the screen shows prime grade, so think of that as higher grade or institutional quality assets in blue. The red is secondary assets or lower quality assets, and it's charted with all the major office markets. A very clear trend you can see here is that secondary or that lower quality stock is actually losing tenant customers in the 12 months of September 22. Whereas the prime, i.e. higher quality assets, is attracting more and more tenants into the buildings. So you can't just look at the office sector and say all office assets are equal. Tenants want to be in new buildings with great environmental ratings, terrific amenity, close to public transport, close to their clients, that also are hygiene focused. And you often only get that in the newer institutional quality. And at Charter Hall, that is why over a long period of time, we've focused our office portfolios at that higher end. We thought that the lower quality simply wasn't worth the risk and you weren't being rewarded enough for the extra income on those lower quality assets. This next chart's just a different way to express what I said around tenants are clearly favouring higher quality assets over lower quality in the office sector. The prime quality is the blue line, the grey line is the secondary, and on the vertical axis is how much square metres of space has been leased. What you can see there is that gap between tenant demand, and they're voting with their feet here in terms of where they're signing leases, is widening between that prime and lower quality assets. So now bringing it back from a macro office market level to what it means for DOF, our flagship office fund, and PFA, what you can see on this chart up there on the screen is we've charted their occupancy rate, so how full these buildings are, against the grey line, which is the PCA or Property Council of Australia benchmark. The occupancy rates for our two office funds have materially outperformed the benchmark over all time periods. What I want to stress here is this isn't an accident. This has occurred because we do focus on those prime quality assets, and we've got an in-house capability with detailed, experienced asset management team members who have consistently extended leases and attracted new tenants into our properties. The reason why we like very high occupancy rates is because not only do they support the distributions that we pay to investors on either a monthly or quarterly basis, but it means you aren't as impacted by short-term movements in the market. By that I mean we can go into the market and engage with tenants when the economic conditions are right, and we can do that because our buildings are almost full almost all of the time. I'd now like to introduce our first guest speaker, Andrew Cole, Group Head of ESG at Charter Hall. Andrew joined Charter Hall in 2021 and he came from a major property group where he'd worked for 14 years. Prior to this, Andrew also worked for the New South Wales Department of Planning, supporting sustainability policy for residential homes and industry engagement. Andrew is a strategic thinker, exceptional communicator, and a subject matter expert in sustainable real estate and environmental, social, and governance issues. In his role, he's been trusted to represent Charter Hall at an international level on sustainability reporting, responsible investment, and sustainable finance matters. And today, Andrew will be discussing our latest sustainability report, highlighting our approach and our achievements. Please welcome Andrew.
Thanks, Steve, and great to be with you all today. A continued focus for the group moving forward will be our approach to sustainability. Increasingly, we're seeing investor and tenant customers demand real estate and real assets that have environmental, social outcomes and initiatives alongside financial returns. For us as a business, we see this as both the right thing to do as it relates to our social licence to operate, as well as the smart thing to do. Especially at this time, we see strong energy efficiency and access to on-site solar and clean energy, lowering our cost of operations and supporting long-term risk-adjusted returns and superior gross asset values over the long term. Across our group, we've had great results in the FY22 period, and we're responding to investor and tenant customers and their appetite for low carbon or net zero carbon products. As a group, we've listened and we've accelerated our net zero carbon target for Scope 1 and Scope 2 emissions where we have operational control, bringing forward our date from 2030 to 2025. Now, our acceleration for 5 years is underpinned by continued investment in 5 key principles of lowering the carbon emissions within real estate. The first, energy efficiency. We continue to invest in energy efficiency and support lower cost of operations within our assets. And we are linking plant and equipment upgrades over the life cycle of our assets to really harness and drive energy efficient outcomes. The second is our continued investment in on-site solar. From FY19 to FY22, we've rapidly increased the amount of solar panels that we are providing, especially in asset classes like industrial and retail, which have very large roofs to accommodate on-site generation. In fact, the 47.2 megawatts of solar installed at June 30, 2022, power the equivalent of about 16,500 homes each year. The other way that we're accessing clean and affordable energy for our business is through direct procurement. In FY22, we engaged the electricity market and struck a partnership with international electricity company Engie and their Australian retail arm here. And pleasingly, that is directly investing in solar and wind projects across the national electricity market in Australia, being Queensland, New South Wales, Victoria and South Australia. The other way that we're thinking about decarbonisation is through the transition away from fossil fuel plant and equipment. We know that in buildings, gas is used for cooking, heating space and the provision of hot water. We're looking at our existing assets and integrating electrification or fuel switching strategies to those underlying assets. And where we're developing new assets, we are looking at all electric plant and equipment, which will be powered by on-site or off-site renewables, operating carbon neutral day one. The final step in our net zero carbon roadmap for those emissions under our operational control would be offsetting. Approximately 12% of our residual emissions come from diesel and gas use within our assets. Where we are unable to electrify or where we know electrification of buildings will take some time linked to strategic asset planning and life cycle of plant and equipment within the underlying asset, we appreciate that a residual offsetting mechanism will need to take place. It's now my great pleasure to introduce our next guest speaker, Sarah Blankfeld. Sarah joined Charter Hall in 2019 and is responsible for investor relations for the direct business, as well as sustainability reporting and communications for our direct suite of funds. Sarah's been a key part of our ESG community and helping to strengthen our capacity across the group. Prior to joining Charter Hall, she worked with RICS, a global professional body for the built environment, in both London and Sydney for 6 years, and gained a Masters in Real Estate Finance and Investment from the University of West England. Sarah will now take us through a sustainability case study of 60 King William in Adelaide. Welcome, Sarah.
Thank you, Andrew. What do we mean when we say that we're putting sustainability and value creation at the heart of our decision making? To bring to life some of the targets that Andrew presented, I'll be taking you through a case study of an office asset, which is currently under development. 60 King William Street in Adelaide is 25% owned by the Direct PFA Fund as part of a Charter Hall partnership. It is the largest commercial real estate project in Adelaide CBD. To us, there are 3 main aspects to value creation through sustainability in the development. Beginning with environmental action. As Andrew mentioned, we are accelerating our net zero target for Scope 1 and 2 emissions to 2025. This is 5 years earlier than our previous target. We're proud that 60 King William, when complete, will become Charter Hall's first office development enabled for net zero emissions in operations. This means that it has all-electric plant and climate-friendly refrigerant. Buildings that are all-electric don't use fossil fuels for heating and cooking. With Charter Hall having procured grid-supplied renewable energy for the office sector, the building will be entirely powered by renewable energy. These initiatives mean that the asset is targeting a 6-star Green Star, 5-star Neighbours Energy, and a 6-star Neighbours Waste rating. These are not just industry-leading targets, but world-leading targets. We know that highly rated assets attract quality tenants for the long term because they reduce the operating costs of assets, contribute to tenants' net zero goals, and create a desirable workplace for employees. Secondly, sustained returns at 60 King William. As a business, we believe that creating environmental and social value alongside financial returns drives long-term success. An example of this is the debt for the development, which from May 2022 has been classified as a green loan. To qualify for a green loan, developments must be environmentally sustainable. This directly links environmental outcomes to financial value. Thirdly, community engagement. Health and well-being have been designed into the heart of the building, creating value for investor customers by supporting the attraction and retention of quality tenants. Employers are realising that they can enhance and improve productivity through healthier buildings, perhaps even reducing staff turnover and absenteeism from sickness. There will be many services available for tenants to address both mental and physical health. These include wellbeing programs and content delivered through the building's Charlie smartphone app, as well as a wellness centre and exercise space. With employees increasingly expecting better working conditions that are safe, comfortable, and enjoyable, these amenities are vital to supporting and retaining happy tenants in our assets. We understand that a focus on sustainability helps to deliver long-term sustainable value to our investors, tenants, and communities. 60 King William is a great example of how we're delivering for all of our stakeholders. We'd be delighted to hear from you if you'd like to learn more about sustainability within the direct business. If you have any questions about what Andrew or myself have discussed today, you can email directproperty@charterhall.com.au. Thank you.
Thank you for that, Sarah. A terrific case study on 60 King William Street in Adelaide, and it shows what Charter Hall are focused on in modern office towers. This now brings me to the part of today's presentation where I'll give you a little bit of an overview on the Direct suite of funds. The first fund I'll talk about is the Direct Industrial Fund number 4. It's a $3.16 billion diversified fund with an average weighted lease expiry of 10.7 years. As I said earlier, industrial and logistics tenancy markets are extremely tight, and that is reflected in this fund's 100% occupancy rate. No small achievement when you consider the fund has over 50 assets that are diversified across Australia. The chart on the right shows the major tenants, the Australian government, the largest tenant at 13%, and in fact, you'll see the government as the major tenant for DOF, PFA and LWF as well. Other major brands in there are Bunnings, Kmart, Woolworths, Coles, Inghams. The top 10 tenants represent 53% of the income, and as you'll see as you watch these quarterly reports over time, we continue to bring in ASX top companies and large private entities, and we do this because we want tenants across our suite of funds that are financially strong, generating great cash flows and have robust balance sheets. I'd now like to show you one of DIF4's high-quality Australian industrial and logistics properties. The video I'm about to show is the purpose-built distribution facility located at 4/18 Translick Avenue in Launceston, Tasmania. The asset is 100% leased to ASX-listed tenant Woolworths Group and has a weighted average lease expiry of 16.4 years. It provides fixed annual rent reviews and is in line with the fund's investment strategy to purchase high-quality assets to well-regarded tenants. I hope you enjoy this short video. It's great to be able to show you a video. I think it gives you the scale and the impressive nature of some of these high quality industrial assets. The next case study I show, I only have pictures. It's so recent we haven't yet been able to film a video. It's a geosciences building located in Symonston, ACT. DIF4 picked up a 50% interest valued at $181 million. It has a long weighted average lease expiry of 9.7 years, leased to the Australian government, and is obviously 100% occupied. It is core infrastructure for the government and holds the Geoscience Department as well as a National Earthquake Alert Seismic Centre. We like assets like this because they are highly resilient and the tenant is very sticky. It doesn't mean they're guaranteed to stay, but it does mean you have the best opportunity when they've got such large amounts of infrastructure and capital invested in the premises. Moving now to the first office fund I'll talk about, the PFA fund, which is a little over $2.5 billion. Occupancy 99%, so not quite 100%, but very close. It has a 5-star global ESG benchmark rating. And I know many of you in the audience may be a little bit skeptical on why we've talked so much today on ESG. I can tell you the tenants are not skeptical. And the reason why we've focused on ESG for a long time at Charter Hall isn't just because it's the right thing to do commercially, but we need to do it if we're going to attract these top tenants. So if we neglected to focus on this, if we didn't have such high environmental ratings in our portfolios, we simply would not be able to attract the government, tenants like Woolworths, because it's so important to them. In fact, when I talked to the office sector earlier, that prime and secondary assets, one of the key differentiators is the environmental rating on the buildings. So please don't think we're focused on ESG just because it's a topical, it's the word of the moment. We're focused on it because it does underpin the value of your investments and the properties that combine to form the portfolios that many of you have invested into. The top tenants in this portfolio, the government at 60%, that spans federal, state and territory governments. Then you've got other major tenants such as American Express, University of New South Wales and Bega. The 10.9% return is the return PFA has achieved since it was relaunched, and that's a fantastic return to be able to generate from a lowly geared office fund focused on such resilient tenant customers. Before moving on from PFA, I'd just like to highlight the results of the 5-year scheduled liquidity event. 82% of investors elected to remain invested in the fund. So for those 18% who chose to redeem, the management team are working through a liquidity strategy, and the expectation is liquidity will be delivered during 2023. If you participated, please do keep an eye out because we will provide investors with some correspondence as that liquidity strategy is further progressed. Now moving to DOF, our $3.2 billion office fund. 98% occupied, 6.8-year weighted average lease expiry, and it's been able to generate an even higher return since it was first launched at 14.5% per annum. But like PFA, it has a 5-star ESG rating, and that's important because, as I just said, it means that we can attract the tenants like you see on the right-hand side. Australian Government at a third of the portfolio, Western Sydney University, Coles, Suncorp, Westpac, very financially strong tenants, and they comprise 57% of the total income in the DOF portfolio. Now, before I move to our next fund on the LWF, I want to share a video with you on LWF's most recent acquisition. It's a social infrastructure property in Robina, Queensland, and it's a growing corporate, medical and educational precinct. The property is underpinned by long-term leases to TAFE, Queensland, a state government-owned education provider, and Wise Medical, and increases the fund's exposure to government income, now representing over 25% of LWF's net income. So please do enjoy this short video on one of LWF's most recent acquisitions. Moving now into the detail on the LWF portfolio. But before I do that, just remember LWF is a diversified fund. It taps the expertise of Charter Hall, and we get to allocate and pick the sectors that we believe will generate the highest returns for LWF investors throughout the cycle. The fund invests into social infrastructure assets like the video you just saw, high quality office assets, as well as industrial logistics and some small amounts of hospitality and telecommunications. The fund is over $600 million of GAV, a very high occupancy rate. Again, all our funds target high occupancy at 99%, and has a weighted average lease expiry of 8.9 years. The fund has generated 11% per annum returns in the 5 years since it's been launched, and like the other funds, has a very high quality tenant roster with government, Coles, Bunnings, Endeavour Group and Primo, who are a food manufacturer. Moving now to our most recently launched product, the Wholesale Property Series number 2. It does have a high minimum investment of $250,000 and is only available to sophisticated and wholesale investors as defined by ASIC. It has a long weighted average lease expiry of 11.8 years, is diversified across all the core real estate sectors, and has exposure to an underlying portfolio of properties of 223 assets. The top 5 tenants are on the right-hand side, and this fund is a little bit different. It only does monthly allotments, with the next allotment date scheduled to be 17th of November. I do want to highlight, if you are interested in this fund, do read the information memorandum because the structure and investment style is slightly different to our other funds that I've talked about today. The next slide details our fixed life funds, which are no longer open for investment. But I do know many of you have investments into these, so I always like to give an update at these quarterly videos. You can see here the unit price of each of the funds as at 30 September. The 12-month returns are simply fantastic, which range from BW Trust at 23.4% and WPS1 at 18.9%, with DIF2 and DIF3 fall in between those. 3 of the funds have 100% occupancy, and WPS1 has a very high occupancy rate of 98%. What I would highlight is DIF2 is approaching its fixed life end and will shortly write to investors around an option to take either script into one of our other funds, which we expect will be able to provide capital gains rollover relief, or you can elect the full cash option. At Charter Hall, we believe it's very important to let the investors decide what suits them. And so please, if you are a DIF2 investor, do keep an eye out for that letter, which you'll hopefully receive in the mail shortly. Thank you for joining us today. If you'd like any more information on any of the opportunities that are currently open to investment, you can visit our Advisor Resource Centre at www.charterhall.com.au/advisors, or do contact one of our team. Thank you very much.